Hello and welcome to Livewire Markets. My name is Chris Conway. The landscape for alternative investments has changed and continues to change dramatically amid increasing demand from investors and a proliferation of alternative managers. Where the conversation used to revolve around lack of access, lack of liquidity and opaqueness, now the conversation centres on which managers and opportunities an investor should pursue. But are investors suitably informed about alternatives? Or are they caught up in the same wave of excitement that has delivered a plethora of new products and seen the big international alternatives managers arrive on Australian shores? To answer that question, there are few people better placed than Michael Houghton, Chair of the Investment Committee and Chief Investment Officer at Lucerne Investment Partners. Michael has more than 25 years of experience in markets, having worked in wealth management, investment advice and portfolio construction. Michael will be talking to us today about the shape of the alternatives landscape and its unprecedented growth, and how he and the team at Lucerne select the best opportunities and invest money on behalf of clients. Michael, it's been about 12 months since Livewire chatted with Lucerne. What has changed in the alternative space in that time?
There's probably a lot changed, but for me, the thing that I've noticed the most is the awareness in the mainstream investor market. A lot of advisor groups, a lot of individuals, self-managed super funds are all interested in alternatives and how they can invest in them. I think what hasn't changed, which has surprised me, is the lack of availability for that more mainstream investor market. We're still the only real liquid alternatives investment available that's in the retail space for that investment market, which has been quite surprising.
Michael, you talked about awareness. Do you think the industry has done enough in educating people about the opportunity in alternatives, or is there still more work to do?
I think there's a lot more work to do. Awareness is one thing, but actually ensuring that people understand what they're aware of is another. And I could talk about many different examples, but I think that the key one is there's a lot of funds that are coming into Australia. They're talking about alternatives. They're wanting to offer options in the alternative credit space, private debt, private equity, anything that you can think of, but they're all offering it in a way that's typically still only accessible to institutional investors, and liquidity is absent. A lot of them talk about, and this is probably one of the biggest bugbears in the education piece from our perspective, is that a lot of them talk about liquidity, but they're actually offering it on a very conditional basis. And what we've seen in the last few weeks is about $6 billion worth of funds being gated, meaning cancelling your ability to redeem from that fund because they were never liquid anyway. And I think the simplest way to look at some of those things from an education perspective is if the underlying assets aren't liquid, then the fund can't be liquid. And that's one of those pieces of information that investors need to keep in mind.
Michael, is there any chance that the alternative space becomes overcrowded, or is it in fact overcrowded now?
I don't think it could become overcrowded if you look at it from the point of view of quality. Yes, there's a lot of new managers coming in, some of them really experienced, offering some great ideas, really good opportunities, access to investments that typically have been difficult to get access to. But again, that mainstream, the retail, that self-managed super fund investor is going to find it really difficult to participate in those investments. So for them, it's not going to be overcrowded. From our perspective, it is becoming so. And one of the other aspects of that we're really have noticed is the lack of experience. So there's a lot of fund managers operating or opening up in the space and offering an alternative investment, but don't necessarily have the experience or the capability to support what really is and can be a complex space.
Michael, there's also an increasing international presence. Lots of the big international alternatives managers are casting their rod into Australian waters. What does that mean for the local players?
There's always going to be an opportunity for new funds to come in, whether they're here or offshore. There are some really good fund managers in Australia. We've invested in quite a few of them, but likewise our own geography makes it difficult to access some really good ideas. And what we're noticing with those that are coming offshore that are getting the traction, whether they're big established managers like the Goldman Sachs or JP Morgans, or whether they're new managers that you or I haven't heard of, is what are they bringing to the table. The other part of it though, even with the big fund managers, is they've probably underserved the Australian and the Southeast Asian market more broadly. It's been very Europe or US focused. So I think that it's only good that you're having more managers coming in offering different access to different asset classes and opportunities for investors to have a much broader universe rather than just equities or bonds.
Michael, let's talk about the way that Lucerne does it, because you have been in this space since 2015 and have a fairly impressive track record. What is your process and what is the Lucerne process for sorting the good managers from the bad?
Yeah, it's a really good question, and it's one that I could probably talk for 20 minutes just on that and still not complete the answer. So if I was to look at it from the perspective of how we go about it, it's probably, first of all, I try to identify things that we think are going to unfold over the near to medium to longer term that we want to participate in. Once we've identified that theme, then we try to think about how can you actually invest in that theme? What sort of strategies are capable of exploiting the opportunity that we think exists, and how would you go about it? And then look for a manager that can actually deliver on that or is delivering on that already. And that process sounds very straightforward in such a short space of time, but it's quite complex. There's a lot of questions. We've got hundreds and hundreds of thousands of data points just from the experience and the amount of time that we've spent assessing all this. We've probably having somewhere in excess of 200 meetings a year with managers, where every time we meet with them, we do a lot of work on researching them, understanding them. We've got our own existing portfolio investments that we can use as a benchmark for what we look for in new opportunities. And then we've got a bench that's pretty extensive as well that we keep monitoring and following and thinking about how are they doing what we would like to see versus those that we're already invested in, and can we alter the way that we allocate? What are they doing that's successful? What is not working? Sometimes it's harder to sell something than it is to buy something, and so we're very conscious of that as well, and we're making sure that the managers that we do invest in and the themes, the ideas, the strategies are all delivering what they say they would, and being prepared to actually redeem from those if they're not doing it as well.
You've talked broadly there, Michael, about the process. I really want to hone in on 2 or 3 of the critical elements that you need to see and Lucerne needs to see in order to make that commitment, to make that investment. What are those critical elements that you really need to observe?
I think the first one is that they do what they say they will do. It's such a common response and people talk about it all the time, but to that point I made before, it's very difficult to actually make a decision to sell something, and that goes for managers that we invest in as well. So first of all, they've got to do what they say they can do. That's just a non-negotiable. That they've got the capability in that space. They've not just decided they're going to set up and operate a fund in private credit, but they've never worked or managed money in that space before. And then the other thing is that they're actually going to deliver on the theme that we want them to deliver on. If they say they're doing private credit, we don't want to see them go out and start managing volatility futures. So again, it comes a bit back to doing what they say they would do, not just in performance, but also in how they go about managing the money and allocating those investments as well.
Michael, before we talk about some of the investments that you've made recently, I just wanted to ask what your clients have been asking you. What are they concerned about at the moment? What have they been coming to you with, and what opportunities do they want to pursue?
There's a couple of things there, and I think the first one is to understand alternatives. I've spent a lot of time in the last 12 months talking to a lot of investors, whether they be advisors or self-managed super funds or individuals. And the key thing that keeps coming out is that uncertainty about the space and understanding it. But then talking about liquidity, which I've spoken about and I'll talk about a lot. I've with somebody else coined the phrase liquidity washing. I've all heard of greenwashing. I think there's funds out there that talk about liquidity that doesn't exist, which I've already touched on. That is one of the things that concerns investors because they've seen or are in funds that have gated, and so they think that's what alts do. You get into them, they're saying they're liquid, then they're not. So just being able to educate them about that space, that's the feedback and the questions that we get. And then the other piece that they really want to understand is the risk. For some reason, the word alternative seems to denote risk to investors. And yes, they can be. There are some alternative investments that we've made that are incredibly risky. But if you put them together in a portfolio that's well structured, then that risk can be managed and mitigated. And our portfolio has volatility that's half that of equity markets. It's achieving equity-like returns. So you can manage that risk quite well. And that's the other key concern that investors have, is understanding the risk. So liquidity and risk, they're probably the 2 key things that we always want to make sure people understand when they're making investment decisions. And if I can just go just a little further on that, there's one other point that's important to make is an allocation of alternatives isn't something we're saying that has to displace an allocation to something else. Alternatives only need to be 10 to 15% of your portfolio to be able to achieve a meaningful contribution to its return and to reduce its risk. And we've done some research on that, and to give a high-level example, on a simple 60-40, 60% equities, 40% bonds type portfolio, if you reduce both of those by 5 and put 10% into alternatives, you've still got your exposure to equities, bonds, got a 10% exposure to alternatives. That will give you a 1% additional performance on your portfolio, and will actually reduce your risk by anywhere up to about 0.5% on the volatility number as calculated through what we do. So it's a good thing to consider in your portfolio construction.
Michael, I just want to ask a couple of follow-up questions there. They're not on the sheet, so bear with me. The first one is around liquidity, because you have made a point of it a couple of times throughout the conversation. How has Lucerne solved that problem, or how do you mitigate that liquidity risk? What are the practical things that you're doing?
Well, first of all, whatever we invest in has to be capable of being liquidated in the way that they say they can. So the way that I would describe that is our fund has the ability to invest in anything and everything. Then we have an underlying requirement that only 20% of the fund can be invested in illiquid assets. So we can go into private equity, venture capital, anything that has a time horizon that's quite lengthy, but only for 20% of our portfolio. The other 80% has to be in investments that can be liquidated in 30 days or less. So we're very diligent about that. We obviously have, being a retail fund, we have a trustee, they scrutinise that as well, and we report on it monthly. So it's a really critical thing to understand, and that's where I think investors can get a lot of comfort. If you were to take a really simplistic approach, if 80% of the portfolio wanted their money back, they could have it back within 30 days. That's the simple way to look at it. And we're not subject to some of those clauses that you can see appear in other funds that might offer monthly liquidity or quarterly liquidity, but then they all say subject to no more than 5% of the fund being redeemed within a certain period, otherwise we will cancel redemptions for 12 months or something. So we don't have those constraints. So that's why it's important to us, because we want, first of all, investors to understand that not all liquidity is created equal, that you've really got to understand what liquidity is, and as the point I've made before, if the underlying investments aren't liquid, then the fund can't be liquid. It's as simple as that.
The other question I had, follow-up question I had, Michael, was around risk, and I just wanted to get your perspective on this. You were talking about, alternatives. People immediately think it's riskier. Do you think that is because the alternatives bucket is quite broad, and there are many asset types that fall into it that have various risk profiles?
Yep, definitely. And I think also there's an element of history that points to that as well. People typically will associate alternatives with hedge funds or with commodity trading advisors or managed futures funds. They've got volatility of 25, 30, 35+%. Whereas if you can have some of those funds in there, you can have some of private credit, private debt, property, volatility, carbon futures, resources, whatever, you can put all that in there. But again, it comes back to how you manage the risk, and that's where our skill set, I suppose, is coming to the fore, because the risk in our portfolio is designed to take on some of those more risky assets and then take on some of the least risky ones and manage them in such a way that the returns are still strong, but the risk is muted. And if I can put that in a way that might make more sense, equity markets like the ASX 200 has a volatility of around 14%. Okay, so that means that in any given day, one standard deviation or one move, big move, could be 14% plus or minus. The fund that we manage, it's sitting at about 6.5%. So that's why I say we'll give you a 10+% return, but with a risk for that of about 7+% or around 7%, versus equity markets, which are targeting that long-term average of about 9%, I think, but with a volatility of about 14-15%.
Yeah, that's really important for investors to understand, so thanks for explaining that. All right, let's get to the fun stuff. Let's talk about what you've been investing in over the last 12 months. Who and what have you been investing in, Michael?
Well, as I said earlier, thematic-led investing is key to how we go about it. We've got 6 key themes. 2 of them that have been really difficult to find good investments for have been carbon markets, decarbonisation is the theme, and also volatility. So we've found 2 really good investments in that space. They haven't been onshore. They're 2 managers based in the UK. One of them is a really small fund, We've been following it for 2 years before we decided to invest in it, and that's on the volatility side of things. We thought we could participate in volatility by investing in the VIX, which everybody's heard of, the fear index. The VIX is just amazingly muted, benign at the moment. Even last year when the equity markets were falling apart, I think it got to about 30.
Right.
At the moment it's sitting anywhere between 13 and 16. And yet there's still so much uncertainty around. So we're looking for someone that can exploit those swings that take place in that index, and that's what we've found there. And they've done an exceptional job, 30+% per annum since inception, and we've been in them for 6 months, and we've already got about 15% out of them. So been a really good investment for us. And the other one is decarbonisation. Such a difficult market to find to invest in. The carbon credit units in Australia are not really that straightforward. The pricing's not transparent, and we were looking for something that was, had deep markets, liquid markets, and price discovery was efficient. European markets are exactly that, regulated carbon markets, both in Europe and the US. This fund manager is out of the UK. One of the things to identify there again is being able to be early into some of these investments is equally important as to how big are they or how good are they, and so on. And this fund, we were the first Australian investor into the fund. We went in about 7-8 months ago when they came here. We went through it, had a discussion, liked how they went about it, what the markets were, and what it would achieve. The only other investor from Australia was an industry super fund, and the fund's closed. That's it. So it got all its money from the UK, a couple of small Aussie and one big Aussie investor, and then it closed. So again, being able to be prepared to find those opportunities, explore them in depth, and do it speedily, and then make an investment decision is really important. And that's what we try to do, is give people access to things they just won't access any other way than by investing with us.
Michael, clearly you have a broad view of the alternative space. What is the one insight that you've become privy to in that position? What's your view from the top, if you will?
I may not look it, but I've been around for a few cycles, and I've seen a lot of market moves over that time. And the one thing that has really stuck with me, and that I hear a lot whenever something goes awry, is this time it's different. Mm-hmm. So for me, this time it's not different. Everything's the same. It might not be as fast, might not be as big, might happen differently, but it's never different. And that to me is a really key thing that I always keep in mind, is what's going on behind, what's underneath, what typically happens when you see these things occur in the market, whatever it may be. Because what we do know is you don't know what it is that's going to cause the markets to react. A pandemic. We had banks collapse last year that seems to have, nobody's remembered that. I think everybody's forgotten about it. It wasn't last year.
Glossed over pretty quickly.
It was this year, actually.
Yep.
And there have been other things over the journey. The GFC, similar sorts of things. Asian debt crisis, all those sorts of things. So there's lots of times where we've always been able to say, but this time it's different. I don't agree. I think every time's about the same. It's just how it happens is different.
Michael, thanks for taking the time to talk to Livewire today.
No, my pleasure, Chris. Thank you.
If you enjoyed that interview as much as I did as part of Livewire's Alternatives in Focus series for 2023, make sure to give it a like, and don't forget to follow our YouTube channel, because we're adding lots of great content every single week.